Right now, about $31.5 billion has poured into covered call and option income ETFs in just the first half of 2025. Yields are screaming 8%, 10%, even 12 to 14% paid monthly. It sounds like the holy grail of passive income, right? But here's the brutal truth: that income you're celebrating, it's your future growth handed back to you early. Put $10,000 into QYLD at launch in 2013, and today it's roughly $25,000. That same $10,000 in QQQ is about $79,000, more than 3 times the wealth. Today I'm exposing JEPI, JEPQ QYLD, the classics everyone's been buying, and 2025's viral news stars QQQI and SPYI, with QQQI even winning Best New Active ETF this year. They promise yield plus growth, but most investors shouldn't bet their future on them. Stick with me, you're about to save thousands and avoid the biggest trap in income investing. Let's talk about the obsession. Retirees, young investors, YouTube influencers, even TikTok finance bros. Everyone's hyping these funds right now. The promise sounds irresistible: monthly checks, lower volatility, and no options knowledge needed. This isn't just a niche strategy anymore, it's a full-blown movement. JEPI sits around $41 billion in assets, JEPQ about $31 billion, QYLD around $8 billion, and the new kids QQQI and SPYI each near $6 billion in under 2 years. Altogether, the broad category of covered call income ETFs now spans well over $100 billion in assets and still climbing. Why? Because bonds still pay around 4%, savings yields are sliding lower, and an ETF promising 8 to 14% monthly feels like cheating the system. But here's the catch. Covered call ETFs sound simple. They own real stocks. JEPI and SPYI hold the S&P 500. JEPQ, QYLD, and QQQI sit on the NASDAQ 100 tech giants. Then they sell call options on those holdings every month. You get the options premiums as your yield. But when the market surges, the option buyer takes your upside and you miss the gains. Translation: you're trading tomorrow's wealth for today's paycheck. Let's point out that they do help in crashes. In 2022, JEPI fell only single digits while the S&P 500 dropped about 18%. That feels pretty good. But in bull markets like in 2023, 2024, and this year, 2025, they lag hard, even the newer, smarter versions. And here's why that matters right now. Heading into 2026, the outlook is turning bullish. The government shutdown looks ready to end. Hopefully it already has by the time this is published. The Fed is in a rate-cutting cycle, and markets expect more stimulus from new leadership at the central bank. There's even talk of direct payments to Americans, policies that could flood the economy with cash and boost growth. If that plays out, 2026 could be a strong year for stocks, and I don't want you capped inside a covered call ETF when that rally happens. Let's cut through the noise with some fresh data. 3 new head-to-head battles that prove the same pattern again and again. Short-term income versus long-term wealth. Battle number 1, the S&P 500 showdown. JEPI versus VU. JEPI is the $41 billion giant everyone loves. It launched in 2020, so we've got about 5 years of history now. Take that same $10,000 investment in JEPI, paying you those 8 to 9% monthly yields, and you have about $15,800 today. In VU, the boring S&P 500 tracker, you have about $20,400. That's $4,600 left on the table just for those monthly checks. And here's the kicker: in 2025 alone, JEPI's up about 5 to 6%. But VU is up 15 to 16%. That 10-point gap on a $100,000 portfolio, 10 grand in missed gains this year alone. Battle number 2, the new hype, QQQI versus QQQ. Now let's talk about the latest craze, QQQI, the fund that just won Best New Active ETF. It's supposed to be smarter, yield and growth, they say. Year to date, 2025, QQQI with its 13% yield is up about 15%, while QQQ, plain vanilla NASDAQ, is up about 19 to 20%. That's $400 to $500 less on a $10,000 investment in just 10 months. Same AI boom, same stocks, but you're capped out of the best gains because you sold covered calls for that monthly paycheck. We already talked about this earlier, QYLD versus QQQ, the OG matchup that perfectly exposes what these funds really do. Remember, $10,000 in QYLD back in 2013, that grows to about $25,000. The same $10,000 invested in QQQ, roughly $79,000. That's $54,000 less wealth for the exact same underlying stocks, all because QYLD kept selling away its upside. Here's the pattern you need to burn into your brain. Every single one of these covered call ETFs, the old ones, the new ones, S&P 500 or NASDAQ, 8% yield, or 14, they all do the same thing. They hand you today's income by stealing tomorrow's growth. The math doesn't lie. Over 5 years, over 10 years, over any serious time horizon, you end up with tens of thousands of dollars less. Now let's talk about the part nobody mentions in the hype videos. That 13% yield you're celebrating, the IRS wants its piece, and it's a bigger piece than you think. Here's the trap. Regular stock gains taxed at 15 to 20% on long-term capital gains. If you hold over a year, covered call premiums taxed as ordinary income, the same rate as your paycheck. If you're in the 24 or 32% bracket, which many investors are, you could be giving up 30 cents on every dollar to Uncle Sam. So that 14% QQQI yield, after taxes, it's really closer to 9 or 10% for most people. Meanwhile, QQQ compounds tax-deferred until you sell, and then you pay the lower capital gains rate. So after seeing the numbers and the tax reality, the big question becomes who should actually own these ETFs? Because despite all the red flags, they're not all bad. They're just often misunderstood. If you're retired or within about 5 years of it, these funds can make sense. Maybe you're living off dividends or drawing down 4 to 6% a year. In that case, covered call ETFs can provide a smoother cash flow. They trade away some upside, sure, but in retirement, income stability often matters more than maximizing growth. But if you're under 50, still working, still building wealth, those ETFs are quietly robbing your future self. That yield you love today comes straight out of tomorrow's compounding. And the longer you hold them as a core position, the bigger that opportunity cost becomes. So instead of chasing yield, build your foundation the smart way. Keep 50 to 70% in broad market ETFs like VU or VTI. Those are your unstoppable compounding engines. Add maybe 10 to 30% in a growth fund like SCHG or QQQ for extra upside, and include 10 to 30% in balanced dividend ETFs such as SCHD, which yields about 3.8% and has delivered about 11% annualized returns. Then, and only then, reserve about 10% for an income sleeve, something like JEPI, QQQI or SPYI, if monthly cash flow fits your goals. That mix gives you a balanced portfolio, steady income today and long-term growth tomorrow. And here's a simple way to check yourself. Ask yourself these 3 questions. Are you retired or within 5 years of it? Do you actually need this income to pay your bills? Is your allocation under 20% of your portfolio? If you said yes to all 3, you're in the green zone. You're using these ETFs wisely. If not, that's your yellow flag. It's time to rebalance toward growth and compounding. Covered call ETFs aren't scams. They're just tools. Used properly, they can smooth out cash flow and reduce volatility. But used recklessly, they can derail decades of compounding without you even noticing. Your biggest asset isn't yield, it's time. And time is the one thing no investor ever gets back. So don't trade 30 years of future growth for a slightly bigger check this month. Play the long game. Build wealth first, then add income later. Remember, this video isn't financial advice, just education, but I hope it made you think differently about what income really means. If you found this helpful, hit like and subscribe and check out another one of my videos right here. Take care, and I will see you next time.